While most investors are piling into the same handful of overvalued tech stocks, there's a quiet rotation happening that could hand you serious returns in 2026. I'm talking about a select group of high-yield value and energy stocks paying out dividends over 7%, and today, I'm walking you through exactly which ones look most attractive. The information in this video is for educational purposes only. This is not financial advice. You should consult with a qualified financial advisor before making any investment decisions, and past performance doesn't guarantee future results. Now, here's the opportunity most people are missing. The S&P 500's average dividend yield is sitting at historically low levels of around 1.15%. Meanwhile, a handful of solid companies are offering yields of 7%, 8%, and even higher. That's a massive gap. This isn't just about collecting a dividend check. We're seeing a fundamental shift in the market. As the AI hype cycle cools down and investors start demanding profits over promises, capital is rotating into real assets, value stocks, cyclicals, and energy. This is a stock picker's market, and today we're going to break down the companies and ETFs that are perfectly positioned for this shift. We'll look at why their yields aren't just safe, but likely to grow, and how they fit into a strategy for building real wealth over the long haul. Let's get into it. First up is MPLX, ticker MPLX. This is a master limited partnership that operates in the midstream energy sector. Think of them as owning the toll roads for America's energy economy. They own and operate the pipelines, terminals, and storage facilities that move oil and natural gas around the country. Here's what makes them attractive. They get paid for the volume that flows through their system, not the price of oil. That means their cash flow stays remarkably stable whether oil is at $60 or $90 a barrel. It's predictable revenue. Right now, MPLX is yielding about 7.85%. And this isn't some sketchy, unsustainable payout. It's backed by strong cash flow. The company has increased distributions to shareholders for 12 consecutive years. Management has made it crystal clear that returning cash to investors is their top priority, which is exactly what you want to hear as an income investor. The investment case is straightforward. The world still runs on energy, and MPLX owns critical infrastructure that makes it all work. They've been making smart acquisitions, especially in the Permian Basin, connecting it to the Gulf Coast. That's a major corridor for energy exports, and it sets them up for growth over the next several years. Now, what's the risk? Some analysts will tell you MPLX trades at a premium to its peers and looks fully valued. And since it's in the energy sector, there's always some earnings volatility tied to commodity price swings. But here's the key data point. Their dividend coverage ratio is strong. They're generating more than enough cash to cover that dividend with room to spare. For an income investor, MPLX offers a chance to lock in a high yield from a company with a long track record of increasing payments. It's the kind of holding that can anchor a dividend portfolio. Next is a stock that plenty of investors love to hate, but whose dividend checks they'd be happy to cash. Altria Group, ticker MO. Altria is the parent company of Philip Morris USA, maker of Marlboro cigarettes, and it's a certified dividend king. That means the company has raised its dividend for 56 consecutive years. Let that sink in. 56 years straight. Currently, Altria is yielding around 7.2%. For a company with this kind of dividend track record, that's a compelling number. Now, the obvious concern is declining smoking rates. That's real. But here's what most people miss. Altria has managed this decline for decades through pricing power. Cigarette buyers are what economists call price inelastic. They don't quit when prices go up. That's allowed Altria to consistently raise prices to offset lower volumes, which protects profits and, more importantly, that dividend. The investment thesis here is about deep value. Altria trades at a forward price-to-earnings ratio of around 10. That's a steep discount to the broader market. All the negativity about tobacco is already priced in. On top of that, the dividend is well covered by both earnings and cash flow. The payout ratio is high, yes, but it's manageable for a business with these characteristics. The risk? Eventually, volume declines could accelerate to a point where even price increases can't keep up. And their next-generation products have had mixed results. But you're being paid very well to take on that risk. Altria isn't a growth story, it's a cash flow machine trading at a discount. If you're building an income portfolio and can handle some volatility, Altria deserves serious consideration. Now let's shift gears from individual stocks to a strategy that can generate monthly income from the entire market. I'm talking about two ETFs that I personally own. The NEO's S&P 500 High Income ETF, ticker SPYI, and the NEO's NASDAQ 100 High Income ETF, ticker QQQI. These funds are worth understanding. As of now, SPYI has a distribution yield of around 11.6%, while QQQI is yielding approximately 13.7%. Yes, you heard that right. Double-digit yields paid out every single month. So, how do they pull this off? It's actually pretty clever. These ETFs hold the actual stocks of the S&P 500 or NASDAQ 100, but then they run a covered call strategy using index options. They sell call options against the index, which generates premium income. That premium is what gets distributed to shareholders each month. What sets the NEO's funds apart is their active management and tax-efficient structure. They use Section 1256 contracts that get favorable 60/40 tax treatment. The thesis is simple. You own the biggest and best companies in America while collecting an income stream that's multiples higher than what you'd normally get. This is powerful for anyone living off their investments or trying to build serious passive income. In a market that might chop around sideways, having a strategy that makes money from volatility itself is valuable. Now, here's the trade-off. In a strong bull market where stocks are ripping higher, these funds will lag the index. That's the deal. By selling call options, you're capping some upside potential. But in exchange, you're getting a massive monthly paycheck. For investors in or near retirement, or for anyone whose main goal is cash flow instead of maximum capital appreciation, that's a trade-off worth making. Combining SPYI for broad market exposure with QQQI for a tech-heavy tilt can create a powerful income-generating core for your portfolio heading into 2026. For the last pick, I want to pivot slightly. Now, I know what you're thinking. Nike's dividend yield is only around 2.4%, nowhere near our 7% club. But hear me out. This is a total return play with legitimate upside. Let's be honest, Nike has been in a rough patch. The stock is trading well below its 2021 highs, dealing with earnings pressure and a multi-year downtrend. But this is exactly the kind of setup that creates opportunity. Nike is a world-class brand, and the market has gotten overly pessimistic. Analyst consensus is a moderate buy, with average price targets suggesting potential upside of around 26 to 30% from current levels. The investment case for 2026 is a turnaround story. The company is executing its Win Now strategy, refocusing on performance products, streamlining operations, and rebuilding brand momentum. This isn't just hope, it's a detailed plan from a management team with a proven track record. And while you wait for the stock to recover, you're collecting a dividend that's roughly double the S&P 500 average from a company approaching dividend aristocrat status with over 20 years of consecutive dividend growth. What's the risk? The turnaround could take longer than expected. Competitors like On Running and Hoka are taking market share. But let's keep perspective. Nike is a global powerhouse with a brand that's second to none. Buying quality companies when they're out of favor has historically been a winning strategy. The combination of potential share price appreciation in the 20 to 30% range or more, plus a growing dividend, makes Nike an attractive total return opportunity to add some punch to your high-yield portfolio. So there you have it. A major rotation from overvalued tech into value and energy is creating real opportunity right now. We covered MPLX, the pipeline powerhouse with a 7.85% yield backed by stable cash flow. We looked at Altria, the unloved dividend king trading cheap and paying over 7%. We examined SPYI and QQQI, the monthly income machines that can form the core of a cash flow portfolio with their double-digit yields. And for some growth potential, we added Nike, a world-class brand on sale with solid total return upside. The market is giving you a choice right now. You can either chase the same crowded trades as everyone else, or you can build a portfolio that pays you well while you wait for deep value to get the recognition it deserves. Building wealth isn't about hitting home runs on wild speculation. It's about creating a reliable and growing stream of income. Now I want to hear from you. Which of these stocks or ETFs are you most interested in? Are any of them already in your portfolio? Let me know in the comments below. And if you found value in this breakdown, do me a favor, hit that like button and subscribe for more ideas on building wealth through dividend investing. I'll see you in the next one.